Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Seller Financing in Our Market.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today we're talking about seller financing. I think the first place I'd like to start is what is the difference in the two things that people sometimes call seller financing? So what is the difference between subject to or sub to and actual seller financing? And so a lot of times I get new investor or investor students who get a little bit tripped up on this because they can't seem to differentiate how the division works in this area. But let's just start with subject to, which we're not going to be talking about today. I do talk about it in my book, No Money Down, which you still can get from our website or you can get on Amazon. And we talk about purchasing with subject to, so you can get more information there. But subject to financing is just that. It is subject to an underlying mortgage. So for instance, if you go to somebody who has a house and they're interested in selling it, but they've got a mortgage on it, we'll say $200,000 mortgage on the house, but the house is worth $300,000, you may be able to work out a deal to buy that home and leave the existing financing in place, and that's called subject to. Depending on the jurisdiction, it may be or may not be a violation of mortgage laws because the buyer who you're purchasing from was the one qualified for the loan, depending on the type of loan it is. VA and FHA are much harder to do that because they have restrictions, pretty tough restrictions, and are hard to do what's called a wrap financing on, and it's hard to get title insurance for that. On a conventional side of things, it's a lot easier to do it with subject to because you're buying that house subject to its existing financing. In all of the modern, it doesn't matter what's deeds of trust, mortgages, those type of things, they're going to have what's called an acceleration clause in them. So there's always a risk that during an internal audit by the lender, whoever happens to own that mortgage at the time, it could be the servicer or the actual lender, if they do an audit on it, or it could be a government agency if it's a government-backed product like, VA or FHA, they may do an audit on that and find that there is a different owner of record on the property now than there is a lien holder, somebody who took out the loan. Term just jumped out of my head, but then somebody that just turned the borrower, then there is a borrower. So the owner of record is different than the actual borrower. And so what'll happen then is the mortgage company will issue what's called an acceleration notice, and that'll accelerate and make the mortgage due and payable. And that means whatever the outstanding balance is, $200,000, is now owed by who? Well, it's actually owed by the person who had sold you the house subject to, and they're actually on the hook for it because they took out the loan in their name. If they didn't go through and do a qualifying assignment of mortgage, then they're actually on the hook for it. Well, what if you bought this house and did a bunch of repairs to the house? Well, not only are they on the hook for it, but you're also on the hook for it because you've got money invested in this thing. So you're going to have to come up with a way to pay that off. And I've noticed that, we get subject to offers on, listings we have on the MLS, properties that we own, whether we're in the process of rehabbing them or even some of our wholesale properties, we'll get subject to offers on those. And I've noticed that some of the larger guys doing subject to have a provision in there that says if there's an acceleration or the loan gets called, that you'll work with them in order so that they can get the house refinanced and put into their name. And because they know that they're going to have some investment in it, because generally, the odds of having the audit happen on day one by the servicer or the the lender is probably unlikely. This is something that potentially would happen, 30 days, 90 days, even maybe a year down the road, and they're much more invested in it. So subject to is taking it subject to the terms and conditions of the existing underlying mortgage, but you're using the credit of the homeowner that's in place instead of your own. So let's talk about seller financing, the difference here. So seller financing, so subject to is not actually seller financing, it's actually lender financing because the lender financed it to the owner that you're buying the house from. On a seller financing, the seller is actually providing you the financing. The seller becomes the bank. They have the equity in the property. Now, can you do a subject to and seller financing combination? Yeah, we've done those. It's part of one of the no money down buying methods that we use. But today I want to talk a little bit more just about the seller financing. Seller financing is where the seller is offering to become the bank for you and take on the risks that the banks would take. Generally, in a seller financing, you can do it through many different methods, but generally there's going to be a mortgage or a deed of trust with a note involved in the process. And that's going to protect the seller, and the note's going to call out the financing agreement on the property. And then they're going to be protected by the mortgage and the deed of trust in case you stop paying or don't pay or something happens, so that the seller then can foreclose. Well, why would a seller offer financing on a house? Well, in today's market, there's a lot of good reasons. Maybe a buyer, even an investor, is willing to pay more for a house that a seller is willing to finance. Now, does a seller have to finance that house for 30 years? No, this is the neat thing. With seller financing, it's totally negotiable and flexible, the terms of the agreement. So you could go in and say, let's just say there's a house in the neighborhood and you approach them and say, hey, I'm interested in buying your house. It's worth $500,000. You offer them $500,000, but you ask them to provide seller financing. They don't owe anything on the property. You could pitch them, hey, I want you to provide 30-year financing at typical market rate. House is worth, $500,000 in its current condition, and you could get a 30-year mortgage in the form of seller financing. But generally, sellers aren't willing to be on the hook that long. They're not in the commercial business. The chance of refinancing probably on this type of a deal is less likely. The industrial, lending institutions know the statistics of how often people are going to refinance, how long their money on average is going to be held. And so they know what their risks are at whatever the statutory or the current interest rate level is. But if you went to a seller and said, hey, I want 30-year financing, I want it at market rate, and I want you to sell me the house in this manner, a seller may come back to you and say, you know what, I'm willing to provide seller financing, but what do you think about paying 1 point over market rate, since you don't have to qualify with a bank? I'm going to take you as you are. I will provide you a deed of trust or a mortgage, just like any bank would, any lending institution would. But I don't want my money tied up for 30 years, so I want to add a balloon to the end of the financing. So they would put a defined period of time, and that balloon could be 5 years, it could be 10 years. I've done 36-month balloons, 3-year balloons. I've done 10-year balloons. And you can do any of those things. Think about it. On the commercial side of things, typical commercial financing has anywhere from 5 to 10-year balloons built into it. You'll get a 25-year commercial mortgage set generally with the rate that is connected to the LIBOR or the T-bill, and then it will have a built-in 5-year call or note on it, of which you have to refinance it. That's one of the way the commercial lenders make money, because they charge you a point or 2 points or whatever every time you refinance that. And when you have $1 million to $5, $10, $15 million mortgage on a property, that's where they make some additional funds on it. So it's done all the time in the commercial side of things, but it can be done on the residential side of things. So one of the things that we do and have done is that when we're looking for seller financing options, is we will try to make the deal sweet to make the seller want to do this, so that we don't have to go to an institution to get the loan. So we'll say, hey, seller, your property is worth $500,000, we'll give you $420 cash, or we'll give you $500,000 if you'll provide seller financing. And market rate, we'll say, is 6% right now, but you give us 5.25%, and we'll give you a 5 or 10-year balloon on the property. Well, why would any seller want to do that? Well, for a lot of sellers, it may be a way of deferring capital gains, pushing their capital gains down the road, and they can take some of their profit on a much more metered basis and offset it by depreciation, making it potentially tax-free income to them. It may be a very good method especially if they're in their retirement years. Maybe they have some debts that they could use that money to pay off. There's a lot of reasons why this is very attractive for seller financing. And so the thing that I get pushback is, well, yeah, but you need somebody who actually owns the home outright in order to provide this type of financing you're talking about. And a lot of times I get this. It's like there just aren't that many people that have their mortgages paid off. Their homes are paid off. Their homes are free and clear. So I thought I'd cover a little bit of the statistics side of things because it's really surprising to see what the statistics are in this. In the United States, around 40% of all of the homes in the United States of America have no mortgages. They're paid off. They're owned outright. That means that there are a lot of homes out there. Every time you drive down the road and you count 10 homes, 4 of those have no mortgages. And that's what the statistics are. And actually, FC data says 38.5%. Finance Band says 39.3% of all homes are completely paid off. So there's quite a few of them. That equates, according to Finance Band, that equates to 33.5 million homes in the United States of America that have no mortgages. So, I mean, that's actually means there's a lot of homes out there that potentially are targets for seller financing. In fact, the top 2 states, I pulled this here, the top 2 states with the most amount of homes that have no mortgages are West Virginia and Mississippi. West Virginia, 53.3% of all of the homes. That means half of the homes. Every other home in the state of West Virginia, on average, has no mortgage and is a potential target for seller financing. In Mississippi, it's 50.1% of the homes. Now, the 2 bottom states are Maryland at 28.2% and Colorado at 29.8%. There's many more of the homes have mortgages in those areas, but that still means that even in the bottom, that 3 out of every 10 homes are available potentially to negotiate a seller financing because there is no underlying debt on the property. Now, we typically look for a couple different things. We look for homes that fit this qualification, homes that have been owned a certain period of time, homes that have no mortgages. We run this through our evaluation platform. And what we typically do too is we look for age-related homes. Because here's another interesting statistic. According to the Census Bureau, fewer than 28% of homeowners below retirement age have paid off their homes completely. That means on average throughout the nation, less than 1 in 3 homes are paid off for people who haven't retired yet. So typically, I want to look for homes that are owned by people who are 55 plus, because out of those, almost 60% or 63% of those homes from people ages 65 and older, retirement age. We normally look at 55 because it's kind of an incline into that from the 28 to the 63%. So we start at 55. We look for people in that classification because there's a lot more opportunities, and then we can make them a seller financing option. Are they all going to receive them? No. There's a lot of people that are not interested in seller financing. But when you get into retirement age, a lot of times they are more inclined to provide seller financing. First off, they're more financially savvy. Second off, they have typically less debt load. Third would be that they often own more than one piece of real estate. They've bought real estate as a part of their retirement portfolio. And if they've had that piece of real estate as a rental property, this may be a way for them to get out of having to do, or manage or deal with your property manager, repairs, all the upkeep and stuff when they have moved into their retirement cycle. And so this provides a good opportunity on the seller financing side of things. So I would say my final thoughts related to this is don't overlook this segment. I know that I'm going to get the questions, well, can you do this with no money down? The answer is yes. Again, we've got some other podcasts that deal with how to do this as a buying strategy with no money down. Obviously, my book, No Money Down, it's still available on Amazon and on our free on our website. We still have it as a free offer on our website. You certainly can go to whitwamwealth.com and download a copy for free. It talks about how to also find seller financing deals and initiate those in a no money down scenario. Because sometimes you're going to find these sellers that they don't actually need cash. It's better for them to maintain a higher carryback number so that their interest payments are much greater and that their cash flow from the property is greater. And if they take some of it in the form of a large down payment, they may have capital gains on that. So you've got to work through that. And you literally can save people tax money on these properties, make them more money in these properties by deferring that capital gains and spreading the payments and the return on their money over time, and becomes a very beneficial means for them. So this is something that I wouldn't just push off. This is a very good opportunity, especially in our marketplace right now, as interest rates still remain higher than what they're expected to be in a year from now. There's still more opportunities out there now because real estate hasn't been moving overall. And we actually have seen in many parts of the nation where prices have adjusted downward, and there's been a loss in comparable data sales, which means values have dropped on homes in some places. So I would say that this is a great opportunity for us in the seller financing arena, and something you certainly should be looking at. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. I invite you to subscribe today and be part of our growing community. And check out our growing list of previous episodes about other real estate investing topics. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, and YouTube, or wherever you listen to your favorite podcasts. This is Scott Whitwam. Be sure to join me on the next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.